Why is tax base crucial for progressive tax systems? Imagine trying to build a ladder that gets taller as you climb higher. The strength of each rung depends on how well it's built. That's similar to how a tax system works. The tax base is the foundation that supports the entire structure. It includes all the income, property, or economic activities that can be taxed within a state. In a system where taxes increase as income or wealth rise, having a broad tax base is essential. If the tax base is narrow, high earners might find ways to hide income or shift it to untaxed areas. This makes it harder for the government to collect enough revenue from those who can afford to pay more. When the tax base covers many sources of income and assets, it helps ensure everyone contributes fairly. States make laws to include wages, investment income, capital gains, and sometimes even wealth or inheritance in the tax base. They also set rules to exclude low-income individuals from high taxes, so those with less money are protected. This way, the system remains fair and balanced. A well-defined tax base also makes it easier to set clear tax brackets and rates. When laws specify exactly what is taxable, taxpayers understand their obligations, and tax collection becomes more efficient. This transparency builds trust because people see that the system is fair and consistent. If the tax base is too narrow or poorly defined, high-income people might find loopholes or ways to avoid paying their fair share. This weakens the progressivity of the system, which is designed to make taxes fairer by taxing higher incomes at higher rates. In the end, the tax base is what allows a progressive tax system to work properly. It determines what gets taxed and helps ensure that tax rates can increase with income or wealth, as intended by state laws. Without a broad, clear tax base, the system cannot achieve its goals of fairness and adequate revenue.